a good show.
Hi, warriors, traders, investors. It's always a great day when I have the opportunity to speak with my trading warrior brother, David Hunter. And David, great to have you back. A lot has happened. It's amazing what can happen in 3, 4 months since you and I talked. And looking forward to catching up with you and where your thoughts are going into the end of the year and into 24. Great to have you, Dave.
Yeah, thanks, Dale. I'm glad to be back, and I think this is a good day to do this. Things are hopping here, I think.
Yeah, well, why don't we just address, do you have any expectations from the Fed today?
Not really. I mean, I'm sure Powell's going to try to temper expectations. I don't think he wants people running away with multiple rate cuts. So I don't think he's going to be exceptionally hawkish, but I don't think he's going to be announcing cuts anytime soon. So,
Okay.
my guess is it'll be kind of business as usual. And in his press conference, he'll try to, he'll talk about the balance risks and saying we still aren't ready to cut, and we think we still have to be pretty prudent here.
Okay, David, a lot of people before we get to the markets are talking about, I believe it's M3, the contraction of it being as great as it was in the 30s. Does that mean anything to you?
Well, two things. One, it does mean something. I'm a monetarist basically at heart, so it means something. But I think you have to realize where you're coming from on that, and whether it's M3 or M2. We had that 5 trillion pumped in back in 2021, and so
Right.
the growth rate is what everybody's taken aback by. It's gone into negative territory, and it's fallen from very high growth to negative growth, and you see it on the chart and you go, oh my god, this is worse than anything
Yeah.
we've had since the 30s. But you have to remember that we're still looking at a balance sheet that is way above anything it's ever been before. I don't know exactly where the Fed balance sheet is today, but it's, I think, down under 8 trillion, maybe some slightly. But it came up from, it was less than a trillion back in 2008, and it came up from 3.5 trillion in 2020. So
Yeah.
so you still have a lot of money sloshing around. Although at the margin, they are tightening aggressively. And as you know, I'm calling for a global bust next year. And that's part of the reason, is because I think
Yeah.
they do not understand that with a lag, what they're doing is going to create havoc.
Okay.
But in the short run, I think people are getting overly excited about a growth rate that's gone
Okay.
negative.
All right. You got a trillion here, a trillion there, a trillion here. What's the difference, right? I mean,
Right.
what a quadrillion. I don't know what it's going to end up, but Dave, why don't we move to the S&Ps? And I know it's probably too early for you to do a victory lap, but considering the November we've had and where we are now, and I glean that you have actually revised upside targets in the S&P.
Well, my target has been for many, many months 6,000 to 7,000 at the top.
Okay. Okay.
I'm talking, I guess, more about 7,000 these days. So you can kind of read in, between the lines and say maybe he's getting a little bit more aggressive on his upside. But basically, I've always felt that 7,000 was realistic. I just felt it was it was a long way to go, and I wasn't sure we'd get there. I guess I'm more confident saying I think the 7,000 target may be reached. So
Okay.
I'll keep my range of 6 to 7,000, but I think it's really looking more and more like it's going to be the upper end of that range.
Okay. So even the conservative side of your range, 6,000. Like I say, Dave, you're the most bullish long-term bear I've ever talked to on the street.
Yeah, and I think
So,
when we get done today, you're going to say that that's even more the case.
all
I
right.
I, I
All right.
really do I really do think we could see. Certainly, I think there's a decent chance we're going to see new highs, all-time highs this year. So we've got a couple weeks to go, and I think we're probably going to exceed 4,800.
Okay.
May even see 5,000 by the end of the year. Doesn't have
Yeah,
to. I mean,
yeah,
that's very short term and doesn't have to get there by then. But
yeah. It's
that's
for you. That's like just calling a layup. Okay, so anyway, Dave. So what I want to know is even the bulls on Wall Street. Forget the bears because they never got what you were talking about. But even the bulls, 5,400, 5,300. Tom Lee, what, a guy who stayed bullish, always bullish, doesn't come close to your targets and the things that you're looking for. What aren't they seeing that you see?
yeah, it's two things. One, from a technical standpoint, I think we are. If you take a look at we basically take a look at just as an aside, take a look at uh, X, XBD, the stock brokers, um,
Okay.
and you will see as bullish a chart as I have seen in a long time, and it's not that different from the S&P, but base or the semis or what have you. You're looking at many groups that are either breaking out or look like they're going to break out
There it is.
in coming months. I mean, that's a group that doesn't
Yeah.
tell me that we're heading for 3,000 or 4,000.
Yeah.
Um,
The financials have really come to life since the bonds bottom,
yeah,
Dave. That really took the pressure off them.
and if you stretch this chart out, look at a 10-year chart on this.
Well, there you go. You're going back to '07 back here, the
Yep,
bear market bottom.
yep. I
Yes.
mean,
So,
that is
so this is, what technicians call this, the handle of a cup and handle that it's coming
yeah,
out of.
sure, or certainly a rising wedge that looks very bullish. So I think if the brokers are that bullish, how can the stock market be in a bear market or heading rolling over soon?
What a
Um,
great point.
you
Yeah.
know,
You really never have a bear market without the financials being under pressure, do you?
right, and that's exactly right. And frankly, the financials which have lagged the market until recently are picking up speed, as you noted a minute ago. And I think whether you look at even regional banks,
Yeah.
certainly the banks in general, and other financials, they're all looking to me like they're going on to all-time highs and significant all-time highs. So, this is a laggard group that's doing that. You look
Yeah.
at, industrials, they're at their highs all time. Um, you look at obviously the semis are at all-time highs. There's an
Yes.
awful lot of groups that really argue against the narrative that's been out there for a long time that this is just a bear market rally.
But
That
how do
at
you get
the
to,
worst, at the best, it's going to be a double top. That's where people have been.
yeah, but how do you get to your targets of 7,000 compared to bulls that look at 5,400? What are you seeing that they're not?
Okay, sure. Part of it is a thesis. The thesis is that we are late in a secular bull market, and that the move we had in 2020, 2021 is going to be exceeded in both its steepness and its dimension. So you're going to have a bigger rally than 2020 and 2021 to cap a 41-year secular bull market. It looks to me like you're going to go through what I call a parabolic final blow off into a top. And
Okay.
so I think people are underestimating that. Um, Obviously, from a how do we get there standpoint, my thesis is that you have had in the last couple years such a herd effect, all moving to a bearish positioning, all feeling very confident that this thing's at a top or near a top, and why do I want to be aggressive there? And positioning negative, you had a bear market last year, and
Yeah.
people just doubled up on that bearishness, and they've fought the rally that we've had since October 2022 all the way up as a saw this bear market rally, kept thinking every new move up was a top and that it was going to roll over. And so my point is that there's still an awful lot of skepticism underlying this market. There's
Yeah,
still an awful lot of investors, and particularly institutional investors, that are positioned defensively. And we're about to break out to new highs. What
yeah,
I think you're going to see is a concentrated move from defensive to offensive, meaning that it could what might transpire normally over the course of a year in a bull market, I think is going to happen in much shorter period of time. And what that means is you get a buying stampede where you have basically a lot of illiquidity because everybody's on one side of the market, which is buying, and all the defensiveness is
what are you
already happened.
thinking? What are you thinking time wise for this to complete? And I'm showing the Russell that is finally starting to move. I mean, it was frustrating for people who bought it the last year, and maybe we're going to break out here. You're probably looking for new all-time highs in Russell.
Yeah, I am. I'm still calling for 3,000 on the Russell. I think, it has been slow to get started, and it's been part of what has kept people skeptical.
Yeah, it is.
I have said consistently for, well over a year that as we move closer to the top, that the market would broaden, not narrow, which is normal. As you know, as you go towards the
Right.
top, you usually narrow. I think this is going to broaden. So
This is
it's
the everything rally, isn't it, Dave?
it is an everything rally. The thing, not everything. The one thing that I think it is not going to be is oil.
Oil. Yeah, that you made that call a long time ago, Dave. Into, couple of wars, you never turned positive on it. And really XLE has been the weak sister. Look, you could be long everything but oils. Oils look like they're breaking down here.
Yeah, you had every reason to be bullish, given what was going on in Ukraine, given what was going on with the Biden policy, given Europe's situation and
Yeah.
its shortage of energy. You had every reason to be bullish, and yet everything I looked at was saying this was going down, not up. And I think now people are starting to get on board that. So, I think next stop on oil is down to 60. Down
Yeah, I
there
could
you
see
can
that.
bounce. You can
Yeah.
bounce from there back into the mid 70s, maybe not even that far. Ultimately, as you know, I've been saying in the bust, which comes after this melt up, um, I
40,
think oil goes down to 30. So,
30. Okay.
I think it's a bear market in oil that's not about to change.
Yeah. So that must be giving you confidence about the game we're in now and yet the game you're looking for after. So that these things are going to accumulate as this blow off happens. And you're right, the last wave, if you try and trade it, you're going to miss it because you don't get your pullbacks. It just parabolic moves. It's going to be something that most people are going to just watch with amazement, kind of like how gold was before it peaked last week.
Yeah, I don't think gold's peaking. I think gold's bottoming.
Yeah,
So
yeah.
I think they're in very different places. But you're right. I mean, I think from a longer perspective, you have to respect the trend, and the trend in oil is down, and it's going to remain down through the bust. I think so. There's going to be rallies, and if you want to be one of those traders that trades against the trend, when it has counter trend rallies, be my guest. But I just think oil is the one sector that has consistently shown me a downtrend while a lot of things are starting to wake up.
So one thing that you were, probably had to go through a little bit of pain was the weakness in the bond market because there were, times you were calling before we bottomed that you
Yes.
thought we were going to have a turn, and we do have a turn now. Is this sustainable and it's going to trade up with the market, and maybe we get a move up towards 120, which
Yeah,
is,
very
where people were bullish from
yeah,
last year.
very much so. I think we've seen the highs in rates. I think basically the story going forward that's going to help the market rally is that inflation's which has been trending down is going to accelerate to the downside if oil's going where I think it's going. Um, And so the Fed's going to have an easier job in terms of, they're going to have to shift their focus from inflation to, you know, saying, hey, we can't stay this tight. Real rates are moving up when we just sit here. So I think rates have peaked. Nominal rates have peaked. I still think, I think in the very short run, 10-year could be down as low as 380, 390 in a matter of a month.
Yeah.
Um, and probably will go lower from there during the melt up. I had been saying 2.5. That's still a possibility. I'm not sure we get down that far, but basically rates are going to be coming down through the next several months. Um, and and I think the story is the Fed and all the central banks have over tightened. In the short run, I think and not to jump around, but what helps the stock market is I think the narrative that's going to be out there is going to be kind of your cake and eat it too. You're going to have both a soft landing and inflation trending down and looking like the tightening cycle is over. So that helps bonds too, obviously.
Also,
Uh,
for your case, the dollar is now moving in your direction, Dave. Last time I talked to you, we were still heading up here, and we've had a nice failure in the last month after the last CPI number. Uh, Dollar, you're bearish. You're looking for the 80s down the
yeah,
road, right?
I think the dollar can fall to 80 by sometime next year, probably the bulk of that in the first half of the year. I don't know if it carries further than that, but I think 80 is a good target. That's way below, I think, most people's expectations.
It
Um,
is.
and I don't think there's much upside from here. I think we basically had our counter trend bounce, and
Yeah,
the next stop is sub 100,
yeah,
and quickly thereafter probably mid 90s, and then from there
yeah.
we'll go down. So I think the dollar's a big part of the story for the metals,
Right.
and
And the
yeah,
market.
and the market. Yep.
So, how
Um,
about with a weak dollar going? Are there emerging markets that you would be attracted to because of the turn in the dollar?
I have not really looked at the emerging markets. I think you're going to get sympathy rallies around the world.
Yeah,
But to me, the U.S. is the only melt up scenario. People think we're gonna, they use the term melt up for every rally we get everywhere, but
yeah.
melt up is specific to a parabolic vertical run. I don't think you're going to have that around the world because they're not in the same breakout place that we are. The U.S. is, at all-time highs, and or near all-time highs, and I think goes vertical shortly after we make those highs. So yes, there'll
Well,
be
the
rallies.
DAX made new all-time highs too
Yep.
last
Yeah,
week,
there. I
right?
mean, there are markets that are doing okay.
Yeah.
I see the parabolic melt up as specific to the U.S. The rallies around the rest of the world, I think, will pale by comparison.
Okay.
So certainly, I'm just not a follower of EEM at this point.
All
I'm
right.
not saying it can't do well. It's not something I'm close to.
Okay.
I do think you are going to see, um, a real story in Japan as we move through next year. I do think rates are going to break out to the upside there. I do think that the yen is going to have a run here where it can get up to versus dollar can get up to maybe 85 next year. Um, that's going to be problematic for that economy, I think, and problematic for that country at some point. Not immediately, but some point second half of next year. I think Japan's part
Maybe
of that.
they're the fuse for the bust.
They very well could be.
Interesting, David, because yeah, there's a long-term look at the end chart double top. So the way it's paired in retail, you'd be looking for lower.
Yeah.
Right.
I do Japanese
Yeah.
yen versus the
Right.
dollar with the yen on top. But yeah, if you reverse that, you're probably looking at it down towards 100, I would guess, or
Okay.
110, something like that,
All
120. So
right. Yep. And that ties in with a lower rate picture and a higher gold picture because
yes, it does.
they're pretty correlated. I get asked this question a lot. First of all, let's look at the physical silver. Um, it this pullback is pretty deep, right? I mean,
Yep.
that's pretty deep.
Yep.
Where do you buy it? Anywhere?
I think silver is at its bottom right here.
All right,
Uh,
so this is a correction that to buy, to
yeah,
accumulate.
yeah.
Okay,
I think you are looking at basically, um, probably a 30% run from here very quickly, meaning the next couple months.
okay,
And then from there, I still have a target of 60 on silver for next year,
okay,
pre-bust.
okay,
And I've said recently, I even think 75 is possible.
okay.
So that's a hell of a run. I mean, it'd be a triple,
Yeah,
triple from here. So
yeah.
uh,
Gold holding up better too. Buy it here, or could we test 1900? And
yeah,
it's active
I don't
stronger.
think anything's possible, but I don't think you're going down that low. I think you
Okay,
buy it. I think you're right there.
right.
And frankly, again, I look at the miners and I see, you know, 25, 35, 25 to 35% quick moves, meaning the next month or two.
Uh-huh.
Both gold miners and silver miners probably outpace. Um, so
I
it,
wanted
it
to, that was, I know I interrupted, but that's a perfect segue because I was going to ask you about this because I get asked this all the time too. Why have the miners underperformed the physical metals?
Yeah, I think it's a story of um, number one, mining managements are not the best in the world. They do some things that are kind of self fulfilling or they have self interest there. But beyond that, I think the bigger answer is that um, even though we've had a run in gold, we're not far off all time highs. Silver's run a little bit, but it's still down pretty low. I think the costs of mining are so high because it's a lot of the easy mining has taken place. You now have to do a lot. There's a lot tougher to extract what you need to extract. It costs more, so you have to have higher prices to realize the kind of profits that could propel the miners and the stocks. And frankly, that's exactly what my scenario calls for is, you're going to have gold going up 50% or more and silver going up, double, maybe even triple from here, all in the next year. Um, even with the kind of mining situation we have, you've got to believe they're going to be able to make a lot of money. So I think a lot of it is just mining is a difficult business because they operate in you know countries where you can't trust the infrastructure, you can't trust the politics. Just when they start getting their act together, you have a labor strife. Um, you know,
There's land grabs going on, David, in Panama and that copper mine all over the world. Some of these jurisdictions are, saying they're either taxing them more or they want it. So
yep.
that's a risk. And is that why I think conservatively, which SILJ is a conservative investment, but you have the ETF instead of trying to be a guy who knows balance sheets and everything else in all the different miners.
Yeah, it's more about I can't advise and I can't recommend.
Right.
So I use the ETFs as a proxy for the miners as a macro
Yeah.
strategist.
Yeah.
I'm not really recommending them. I'm using my target price to give you an idea of what I think the miners can do. Um, so I'd love
Yeah.
to be a mining analyst and go through the companies. There are people
You
that
did have
do
a
that.
target. You did have a target sharply higher from here in SILJ, right?
I do. I think 35 is my target. And I still stick to that, even though we're down at $9.
Yeah.
Um, and
What
I
it
have a target on SIL of 75, even
okay.
though that's down in the mid 20s. And for the gold GDX, I have a target of 65. And for GDXJ, I have a target of 100. So, yeah, I'm still looking for these things to be big, big winners in this what so-called melt up.
Okay. Well, David, I think we've got the picture. Anything you want to close it with that we didn't cover? I think we covered the board.
Yeah, the only thing I guess I just want to reemphasize, we've spent Certainly 2022 was a year where there was an awful lot of bearishness out there. But 2023, you still have an awful lot of skepticism about the market, concerns about inflation, concerns about, the wars around the world. There, there's still a fairly sizable wall of worry. And then I step back and I look at the charts and I look at what I see as potential. I think the next 3 to 4 months may be one of the most bullish periods in markets. I'm not saying there aren't problems out there, but bullish periods in terms of market performance in history. I mean, that's what I think is we're set up for here.
Okay.
So
You've been
yes,
patient and waiting for this for quite some time.
yeah, well, yeah. I mean, we've had a. I mean, it hasn't been too
We've
hard
had
to wait.
interruptions in your cycles, David,
Yeah,
throughout
but
this.
we haven't had to, it hadn't been all that uncomfortable to wait when, you went from 3,500 to 4,700 now,
Yeah.
in the last, year plus, and the Nasdaq's obviously up, close to 40% in that time. So it, I think what's happened is people are so skeptical and so bearish that they can't even enjoy the rallies. I mean, they keep thinking the next shoe's going to drop. And, my message here is we're about to go into a period that's going to feel like clear sailing. Now, you mentioned before, there is another side of the mountain coming. And so I don't want people to think I'm saying it's all clear for the next 2, 3, 4 years. I think this is going to be a very fast run up. In 2020 and 2021, the bottom to top rally was 21 months, from the March 2020 to December 21. This one, I think, is going to be shorter than that. So if you look at October 22 as the bottom, and you, let's say, go out 18 months, that gets you to somewhere, end of first quarter, beginning of second quarter, right? And that's
Yeah.
kind of what I think. It doesn't have to finish by then, but that's kind of what I think is that the next 3 or 4 months, you could have, the market up more than 50% from here. I mean, that's unheard of.
Yeah, it would definitely be something it'd be amazing and it'd be nice to be long some of the things that what I like about your analysis is, it's a buy everything rally, pretty much. One thing I just did want to mention, some of the Magnificent Seven stocks to me look a little tired. You think people are going to rotate out of stuff like Microsoft if we get a pullback and Amazon, you know, uh, that looks a little tired. And even Nvidia, which was a darling, hasn't made a new high in a while. What do you think?
Yeah, I'm in the other camp. I believe that you're going to see the market broaden out, but that does not mean that the big cap tech does not continue to
Okay.
participate and participate quite nicely. So
Because
I
they'd be
think,
great funding mechanisms for people because there's, a lot of people are own these forever. And if they sell these and buy like the broker dealers that they're probably not in and things like that, they, have more investment capital.
yeah, that's part of my message though, is that really it's not a case where we're so accustomed to this because we've been in this kind of funk for a while that we keep thinking you got to take from Peter to pay Paul. I think it is going to really be, take your,
Okay.
pick your choice. I think Nvidia, where's the stock now? It's,
82, 482.
482. It would not shock me if it was $1,000 stock by mid-year next year.
Okay. I'm telling
So,
you what, David, I wish I would have had decaf this morning after talking to you.
and by the way, I'm not saying it's going there. I'm just saying I don't think this is done. I think there's a big run in semis still to go. I have a target on SMH, by the way, of 300,
Yeah.
and I'm pretty comfortable with that. So from here, that's not quite a double, but it's almost a double, and could double from here. So and Nvidia doubling from here would not shock me. And again, I'm not saying, that fundamentally, that makes sense. That But I think the narrative could drive us there. And then you've got to worry about this could be an all-time top that I'm talking about. If we go to S&P 7,000, and that may not even be the top, it could go beyond that. But if we go there in the next 3 to 6 months, just be aware. I think this is the end of a 41-year run, not the beginning of something. The narrative at the top is going to be that this is the beginning of a new cycle, that we've got a long way to run. I don't believe that at all. I think this is the end of a long cycle.
Okay, my trading warrior brother Mike Venezia says the biggest moves are at the end.
I agree with that.
Okay, so get ready to, see what kind of rocket ship and keep one eye on the house of the rising sun mid-year or earlier, right?
Absolutely. Or earlier. Yeah.
Yeah.
It may stretch out. I've been early lots of times. So, there's no pinpoint timing on this, but I'm just saying the potential is there for it to happen in 3 to 4 months. It might take 6.
Yeah, because that would change the cost of a carry trade, David. If the yen's appreciating, that's a funding currency. So it makes the carry trade more expensive if the yen appreciates.
Yep. Yep. Now
But it
the
won't
thing,
matter with the moves you're talking about.
yeah, I don't think so. And frankly, I think the real thing that's going to trigger this, again, this is not technical, um, but I think it's going to become more and more apparent to the street, but also to the Fed as we move through the first quarter. The tightening is done. That inflation has been conquered. Now, I have said before, and I'll say it again, it would not shock me, it would not surprise me, I should say, if we get, let's say, the S&P is approaching 7,000, or even if it gets up over 6,000, it would not surprise me if Jay Powell looks at that, ignores the fact that the economy is softening, ignores the fact that inflation looks okay, and says, I need to tighten again because things are getting out of hand here. I think Dudley has gotten into his head so much since April of 2022 about the need to get the market lower that he's kind of let it go here because all the time he tried to job on it down, it kept going up. However, I still think in his head is this idea that we can't let the market go too far. And so if we get what I think we're about to get in terms of this big run in the market, it would not surprise me if the Fed comes back and hikes rates at something like S&P 6,500 and says, "Oh, we feel we need to tighten
Too
more."
much speculation,
Too much
froth.
speculation. Yep, and
Okay.
and that will be the classic, what I call the big policy error that's going to bring on the bust. It may happen
Okay.
anyway because I think they've over tightened, but I'm just saying there may be a scenario out there where even though the economy looks soft and even though inflation looks contained, he may still hike because of the market.
Yes, he's haunted by the ghost of what was the name of the Fed chair before Volcker?
Oh yeah, Carter's guy, yeah,
Yeah.
G. William Miller. Yep,
And
G.
they
William Miller.
they had to they paused and then they had to start up 2 more times to
Absolutely.
tighten. Okay.
Yep.
So David, really I'm a fan. I don't even have to say I wish you a happy 2024. I tell you what, you have a historic 2024, David, just like the market. That's my hope for you.
I will do my best, Dale, and you too have a Merry Christmas, Happy Healthy New Year.
Thank you. David Hunter, everyone. Follow Dave on Twitter at Dave H. Contrarian. David will answer your questions too. He takes time to do it. As long as you're civil and respectful, David will communicate with you. So, everyone, I hope you enjoyed it. You may want to watch this one a few times. Thank you, David.
Thanks, Dale.
All right, buddy. Talk to you. Talk to you in the spring.
Yeah, talk to you on the other side.
All right, buddy. All
See
right,
ya.
that's it.